Okay, let's get started. Good morning. Today we're going to start a new chapter, Chapter 3, the adjusting process. While I'm waiting for the monitor to warm up a little, let's just review what we covered last week in Chapter 2. So remember, the main part in Chapter 2 last week was to capture business transactions. Right? Business transactions, for each and every type of activity, we at least identify how many accounts? 2 accounts at least, right? And one has to be on the debit side, one has to be on the credit side. Okay, so just briefly recall the debit credit rule, how it tied to each and every account. Remember, as at the left side, we always record increases for most of the accounts. Okay, so throughout the semester, we'll be discussing some of the other exception accounts, but for the most part, assets increase is always recorded under the debit side. So left side of the equation, whenever we increase, we collect cash, we incur accounts receivable, we purchase a piece of land, purchase building, the values are recorded under debit side, left side. Right side of the equation, we have liabilities, equity. So liabilities, the normal balance is on the right side as opposed to assets. So remember, whenever there is accounts payable, notes payable, if we borrow money from others, if the corporation purchase assets but has not yet provided the cash on time, promised to pay it later, that value will be recorded under the credit side. Okay, now for equity, the right side increases whenever there's revenues, whenever there's retained earnings, whenever there's stockholders' equity, specifically common stock. When we issue common stock, raise capital from the public, it's recorded under the right side. Left side increases whenever there's expenses and dividends. So remember, the nature of expense and dividends, the definition of these 2 accounts basically is either giving away cash or some sort of asset because we're trying to support the business operations. Remember, like rental expense, advertising expense, salary expense. Dividends, on the other hand, is a way of rewarding shareholders. We're also giving away a portion of cash. So those 2 accounts are the exceptions under equity account. Whenever we incur these type of expenses, different types of expenses or dividends, we always record it under the debit side because it reduces the equity account. So this is the main points we covered in Chapter 2. And today I'm going to continue the accounting cycle by adding in another element, adjusting entries. Okay, so we started in Chapter 2 from recording transactions in journal entries, posting exactly the same information to ledger, T accounts. Remember, those 2 represents exactly the same information, just in different format. So journal is recorded by date. Ledger is recorded by the accounts, remember? If we want to trace back changes in certain accounts, cash account after a certain month, how many transactions ties to cash account, then we look at ledger. We want to go back to look at a certain date, how many transactions happened, what are the different types of transactions that happen, go back to journal. So after recording transactions in these 2 different documents, we summarize the information in trial balance. So remember, trial balance is just an internal document, it's not disclosed to the public. It's only for the purpose of capturing the balance in T accounts. So remember, we have debit side, credit side, and then we summarize the balance under the normal balance side, which is the plus side of different types of accounts, and just copy the information to trial balance, just the summary part. Okay, now today we'll be introducing adjusting entries. What it means is that we're trying to bring up some of the accounts that we recorded in ledger and journal, bring it up to date to its current status. Okay, so some of the transactions that happened earlier, after a period of time when we're getting to financial statements, their values has changed and we need to update them to its current status. So a quick example here would be, for example, rental. If you prepaid rent January 1st, let's say you prepay it for an entire year or half a year. If the company is doing monthly statement at the end of January 31st, then what you prepaid before in January 1st, a month of rent benefit has expired when it gets to January 31st. So that will be an example that we have to make an adjustment. Earlier, what we prepaid in January 1st, when it reaches monthly statement due date, when it reaches January 31st, that portion, that 30-day of rent has turned into, from prepaid rent, turning into rent expense. So that would be a type of example of adjusting entries. So there are 5 types of adjusting entries that we need to cover before a company gets to financial statements. After recording a bunch of transactions, there are a few of them, 5 adjusting entries that may need to be adjusted before we actually get to financial statements. Okay, so the purpose here is to update some of the accounts. Okay, that's the whole purpose of adjusting entries, the core for this chapter. Now we'll start from going over some of the theoretical background here. Why are we doing these adjusting entries? So this goes back to the idea, the differences between 2 types of accounting system. One is accrual accounting, one is cash basis accounting. So keep in mind that all throughout the semester we're trying to learn, remember, corporation type of accounting system. So if we're recording transactions, providing information for public traded companies, it's always using accrual accounting system, the first one listed here. Okay, so the concept here, really we covered it in chapter 2 already, just didn't mention that the name is called accrual accounting. What it means is that, remember there's an on-account term. Corporation may be providing services, providing goods on account. That essentially is exercising accrual accounting concept. Record revenue when it's earned, but not necessarily at the same date when cash is received. Okay, meaning that if corporation today sign a contract to provide e-learning services or legal services, financial consulting services, let's say the contract with this client is just for a month. So after a month of meeting time, when it reaches, let's say, the end of February, the corporation has readily provided the service according to the contract, then by the end of this month, that will be the date to record service revenue. So even though when it reaches the end of the month, it's not the same date when cash is actually received by corporation, revenue is already recorded. And if cash is not yet received, then it's considered accounts receivable. So this is essentially exercising the idea of accrual accounting already. Recording revenue, recording either service revenue, sales revenue, regardless of whether cash is actually received on hand, it's already captured in journal entries. If cash is not received, then it's considered accounts receivable. It must have been a promise from client and customer that cash will be paid to your corporation later on. Okay, so that will be an example of revenue. For expenses, it's just the opposite. Now it's the case that corporation has not yet paid out cash, but let's say if rent bill is due, if certain utility bill is due, you have already used the benefit for a month or 2 months already. So you receive the bill, even though you have not yet paid the money today. Once you receive the utility bill, you see the rental bill or other types of expenses contract, then you'll be recording that transaction in journal entry, even though you have not yet paid cash. So if you use the benefit, you have used the location that you rented for a month already, you haven't paid the rental expense, you haven't actually paid the cash, you still record rent expense, and at the same time that will be recorded, the credit side will be accounts payable. Okay, so accrual accounting, the core concept here is that we record transaction as it happens. Doesn't necessarily mean that cash is received or cash is paid out. If it's not received, if it's not paid out, it's considered accounts receivable or accounts payable. Okay, so for all the public traded companies, the financial statements that you will be able to Google online from other finance-related websites, if you see financial statements, you can confidently assume that it's recorded under accrual accounting. So you will definitely see accounts receivable accounts, accounts payable accounts listed under financial statements if the company has actually have some promises that they made before. They already delivered the goods, provided the services, but they haven't received cash from clients or from customers. Or they purchased items, but they have not yet paid the money to other corporations. Then you will see liability account, accounts payables accounts under financial statements. Now, as opposed to that idea, some of the small businesses, just for simplicity purposes, they may be using cash basis accounting. So if they're not regulated by the SEC to actually officially disclose information every single year, they can exercise cash basis accounting and record transactions only when cash is received and cash is paid out. Okay, but this is not a method recommended by GAAP, because this actually sometimes delays some of the transactions recording time. So for example, the case that I mentioned earlier, if we provided goods to customer today, customer promised to pay a week later. Then under cash basis accounting, small businesses will not be recording anything today, even though the goods is already shipped out to others, or even though the services is already provided. The contracts, the responsibility for the corporation side is readily done. But for cash basis accounting, these small businesses, they only record transactions when cash is actually received on the same day when they have the money on hand. Or another example, they already used the location for 2 months and they're paying rental next month, the beginning of next month, let's say March 1st. So even though they have the benefit, that they use up the benefit for 2 months or a month already, they're not recording rent expense until March 1st. So that's the time when they actually record the transaction journal entries. So cash basis is, in terms of recording the entries, is the opposite of accrual accounting. It waits until actual cash receipt and cash payment to record things in journal entries. But for these cases, if that's not the same day when goods are delivered, if that's not the same day when expenses are actually due, then there's a delay between actually providing the goods and recording the transaction. Okay, so this is not a method recommended by GAAP. All the public traded companies are using accrual accounting. Okay, so this slide here basically just summarizes what I talked about earlier. There's revenue. This is an example of, let's say, delivering flowers. This corporation delivers flowers to clients. They only record, under accrual basis accounting, they will record the transaction regardless of whether actually collecting money from client the very same day that this activity happened. Under cash basis accounting, then whenever a check is received, cash is received, that's the time point when this journal entry is being recorded. Okay, so there's a differences in terms of the date the transaction is recorded. If the cash is delayed, accrual accounting still records transaction anyway. If the cash is delayed, cash basis wait until the actual date when cash is received, then they record the transaction. Okay, so basically under cash basis accounting, you will not see financial statements have accounts receivables account. You will not see accounts payable account because, remember, they don't have the on-account idea. They only record transactions whenever there's cash. Okay, so you will not see service revenue accounts receivable, or you will not see certain type of expense, credit accounts payable. You will see the debit side cash, the credit side cash when there's receipt or payment of transactions. Now, depreciation, I will talk about this a little bit later during the chapter. So if you don't get this, that's fine. That basically represents the decline of value for long-term assets. So we'll be measuring that a little bit later. So if we take a look at transactions here, these are 2 cases. For accrual basis accounting, beginning part here, May 20th. So what does that transaction tell us under May 20th? The corporation side, they have service revenue increased, right? But do they have cash yet? No. May 20th, it's accounts receivable because the client has not actually paid the money, even though the service is provided. Corporation side is done, but they have not collected the money, so it's under accounts receivable. A few days later, a few weeks later, June 5th, cash is received, so we debit cash from the customer, and then we credit accounts receivable, which is the earlier promise of asset, earlier promise of cash receipt. We reverse that account and collect cash. If this same transaction was made under cash basis businesses, then this transaction will only appear June 5th when cash is actually collected. Okay, so you don't see the transaction recorded May 20th, even though that's the date that the service and goods are readily provided to customer. Okay, so there's a lag of recording transactions here for accrual basis accounting compared to cash basis accounting. Okay, so this is a revenue example. You will see accrual basis accounting have two transactions. Cash basis, only the date when cash is collected. So for expenses, the same thing. Under accrual basis accounting, whenever the bills are received, that means the benefits you have readily used, this is the date when the transaction is recorded. Under cash basis accounting, only the date when the cash is actually paid out. That's the day when expenses is recorded. So if we look at transactions here, so the first transactions tell us that the company has purchased office supplies and did not yet pay the cash. When it comes to June 3rd, that's the time when they reverse the liability and actually make the payment, $200 worth of supplies. Okay, now under cash basis accounting, you see again there's only one transaction on the date when cash is actually paid out. Okay, now have you noticed another difference here in terms of the account names? Supplies expense. So accrual accounting here, we record the supplies that we purchased, we haven't used up as office supplies. Under cash basis, for any current asset, any asset that lasts no longer than a year, is directly recorded as expense account. Okay, so there are two differences for expenses. Besides the time lag issue, besides recording just one transaction when cash is actually paid out, another difference is that if this asset, in Chapter 4 we'll be going over the different types of assets, what is considered long-term, what is considered short-term. So for all the short-term assets under cash basis accounting, when we purchase it, it's directly considered a type of expense and not a type of asset. Okay, so this is another minor difference here. But the main focus throughout the semester is still accrual accounting. You just need to know what are the differences, different points here compared to cash basis. So we'll not be doing a lot of the transactions under cash basis because this is not recommended. So focus more on accrual accounting. Just notice the differences here. All right, just to summarize a little bit what we covered so far. Left side accrual basis, again, revenues recognized when it's earned, whenever the goods are delivered, services provided. Expenses recognized whenever expenses happened, when a corporation received a bill for using a certain type of benefit for a certain period of time. That's the day when the transaction is recorded, even though the money may not actually be paid out yet. Cash basis, revenues were recorded whenever cash is received, expenses recorded when cash is paid out. Okay, so again, this is not recommended by generally accepted accounting principles. All the public traded companies uses accrual accounting basis. Oh. Oh. Okay, let's move on. The second part here, I'm going to define some of the terminologies that we haven't talked about in Chapter 2, and then we'll go over adjusting entries and some of the examples, how to actually do it. So the whole purpose of doing these adjustments is because we're getting to financial statements, and financial statements are typically given out on a yearly basis, quarterly basis. These are required by GAAP, by SEC. The public traded companies has to give out statements every quarter and also an annual statement at the end of the year. But other interim periods is also possible. So companies can decide to also disclose monthly statement. As each and every month goes on, summarize the business activities for a month period and disclose monthly statement. So that's not required, but they can voluntarily disclose additional information for shareholders. So whenever it gets to issuing these statements, that's the time when some of the adjusting entries need to be made. So we'll be talking about this later on. The purpose of introducing this is tying to the accounting periods, the statements concept, because before we give out the statements, we want to make sure that these accounts represented on the statements are being brought up to date. So it represents the current information. Right, so monthly statements, semi-annual statements, companies can voluntarily disclose these different periods of times of financial activities, operations information. Usually, most of the companies falls under, when they do annual statements, they use calendar years, meaning from January 1st all the way to December 31st. Now, some of the retail stores, they are considered more, they have busy seasons at the end of the year because of Christmas, New Year's. They may decide to follow fiscal year, which means just the ending date is still a year period. It's just that the ending date is different from December 31st. That's all. So they can start the statement February 1st and then end it the following year, January 31st. So the annual statement always covers 12-year period. It could start from January 1st. It can also start from other dates, but as long as it's 12 months, then that's okay. Right, but most of the companies follow calendar year. Other retail stores may follow other dates, fiscal year, and on another date other than December 31st. Okay, so these periodic reports, these statements help shareholders, remember, or other users of financial statements. We have creditors, taxing authorities. Helps the users of financial statements get an idea of, within this period of time, what are the activities that happened within the corporation. Okay, so there may be monthly statement, again, quarterly statement, yearly statement. Now, revenue recognition principle, behind that joining is recognition. Revenue recognition principle guides accountants to when to record the transaction and what value to record in journal entries. So this again goes back to some of the concepts that we readily talked about in the beginning of today's lecture and last week in Chapter 2. Basically what it means is that for any type of transaction that relates to revenue, again, it's always recorded on the date that the responsibility from the corporation side is fulfilled. The inventory, the goods, the products is delivered to customer, or the type of service that you signed related to the contract that you signed with your client is already fulfilled. For certain weeks or for certain months, once the corporation's responsibility is done, that's the time when the revenue is recorded. Okay, so when revenues is earned, it means when service is provided, when the product is delivered to customer, that date the transaction will be captured. When company has completed certain types of agreement that they promised with, that they discussed and they signed with their clients and customers. Now, in terms of the amount, it always goes back to some of these source documents that relates to that business activity. Remember the sales agreement, the contract, source document relates to all different types of documents that can back up that transaction. Okay, so for revenue, it would be sales invoice, could be the check that you received from customer. The dollar amount that relates to that sales agreement, that sales contract, is the amount that we should be recording. So remember the cost principle again. even though later on, if this product has a different market value, we don't go back to change the amount that we recorded earlier, because this is the amount that you actually collected from customer that day. So that will be the amount that you record in the transaction. Okay, so a few months later, a week later, if the market value for that product changes, even though it's identical product, we don't go back to change the number we recorded earlier. So the value is always based upon that source document that happened before, that we have before for this transaction. Okay, as opposed to revenue recognition, the opposite side would be expenses. So the matching principle here represents guidelines for accountants on how to record and capture expenses. So all the expenses, there's some of the examples there: salaries, rent, utility, advertising. These are the costs that incurred that supports the company generating revenue from clients, from customer. Okay, so if you want to sell something, you need a location. You may need to rent a store, rent a warehouse to store up all the inventories. You definitely need personnel. You need to hire people, have a human resource department to hire people with certain professional knowledge to help you actually sell the product or keep track of different processes in the business. You have to advertise your product. You may be able to do some flyers or have some commercials on TVs. Utility bill, definitely, if you rent a place, you have some of the water bills, electricities. All of these needs to be actually paid out in order to make this operation actually work and happen. Okay, matching principle guides accountants to record all of these expenses, the costs that happened during a certain period of time. As long as it happens within this period of time and it relates to the revenue that you generated within this period of time, it all has to be accumulated and captured and matched against the revenue that you recorded. Okay, so this essentially is the idea of how income statement comes from. Remember, income statement, we're going to identify at the end whether there's net income or net loss, right? So the idea there is to match up all the expenses, the costs that you incurred within this month. This intended purpose is to support all the revenues that you generated within this month or within a quarter. So we want to know all the costs that we actually incurred, we accumulated, whether or not it's still less than the revenue that we generated. If it's less than that, then there's net income. If not, this period of time, there will be net loss. Okay, so matching principle essentially is going back to the idea of income statement, which earlier we already talked about what the statement is. What are the accounts that falls into this statement? All the revenues and all the expenses. Okay, but the theoretical background here, we call this revenue minus expenses. The idea under this is matching principle. We're trying to match all the costs that incurred within this month against revenue to see if there's profit left. Okay, now some of the expenses you may find easier to link to net income. For example, if the company hires people to actually help them, salesperson to help them advertise the product, to actually sell the product to clients, persuade them to purchase the products. And these people, their salary, these salesperson, their salary, typically a portion will be tied to how much the sales revenue has been generated. So the more sales revenue there is, the more commission will be given to salesperson. So this type of salary expense is easily linked to sales revenue. But there are still other types that is supporting the business in the background, like rental expense. You may think utility expense. These are the costs that runs in the background. You may not necessarily think it actually supports the differences in sales revenue, but you definitely need a location to store up the inventory. Right? You need a place to actually let customer to come in to purchase the items. utility expenses there to support the entire operation on a daily basis. Right, so these are the type of expenses that you may not necessarily think it links to sales revenue, but it actually does. So these are still the costs that we add up and we subtract from sales revenue. Okay, so overall, the two principles, revenue recognition, matching principle, together will determine what's the amount of revenue recorded that will be recorded this month, what will be the amount of expenses recorded this month, and overall, what is the net income and net loss that's generated within a certain period of time. Okay, in summary, that's what these few slides means. Okay, any questions so far? There's a lot of theoretical background here. Okay, we have one last concept to cover, and then we'll move on to more of the exercise side. The time period concept here. The time period concept guides owners to a corporation to periodically give out financial statements. So the accounting period concept gives you the idea of an annual period, what would be the cutoff point. The time period concept here guides corporations to give out these statements on in certain intervals. So remember that it's required for them to give it out financial statements on a quarterly basis, annual basis. They can also decide whether or not to give out monthly statement, but it at least has to be annually and quarterly statement. With all these statements, it updates the accounts to a certain period of time. So if the monthly statement is from January 1st to January 31st, then you will be seeing all the accounts that are being brought up to date to January 31st. It should be the information that relates to that date. Up to that date, what's the cash amount that the company has on hand? Up to that date, what is the accounts receivable? What is the cash that the company expects to collect from customer later on? Or accounts payable? Or what is the current retained earnings amount? Okay, so the information will be, all the different accounts should be brought up to date after recording these transactions, posting to ledger, and adjusting them. Then the company gives out financial statements. So this refers to different intervals of financial statements. Okay, now here's an example of adjusting entries before we actually go into different types of adjusting entries. This is a salary expense type. Okay, so for this transaction here, let's say earlier that the company hired a person to start work for the business starting from May 1st, the beginning of this month. Let's say the salary, the paycheck is given bi-weekly. May 15th, there's 2 weeks of work of check will be given out to this personnel. And then June 1st, another check, bi-weekly check will be given out. So if the company wants to do a monthly statement at the end of May 31st, since the pay date is June 1st, for example, the pay date is June 1st, when it reaches May 31st, the company would have to record the transaction that relates to this person working in your business, but you have not yet paid their salary. Okay, so this is what this transaction means. Last paycheck was paid May 15th. Next one would be June 1st. So in the middle of these 2 weeks, we have this employee still working for the company for 2 weeks, for 10 days, and let's say the salary altogether is $900. So in this case, when it reaches May 31st, because the monthly statement only captures the transactions from May 1st to May 31st, we will not be capturing salary expense that we are paying off June 1st. Okay, it only ends May 31st. So this will be an example of a transaction that we record the salary expense that the company incurs starting from May 16th all the way to May 31st, the 2 weeks. So So this will be recorded as an adjusting entry like this. Debit salary expense, credit salary payable. And the reason why it's payable is because it's not yet June 1st, but we have to do a monthly statement that ends May 31st. So this financial statement will only cover any transaction that falls under May 1st to May 31st. This is still considered a liability for this corporation. Okay, so this is an example of adjusting entry. Because earlier when you paid off the check, that definitely will be recorded as salary expense and credit cash. But that transaction already has been done in the middle of May. When it reaches May 31st, if we don't record this transaction, then it seems like we don't have an employee that has been working for us between May 16th all the way to May 31st. So without this transaction, salary expense will be understated. So without this transaction, then later on the information you see under financial statements, net income will be overstated. Okay, the reason why, again, we're capturing this transaction goes back to matching principle. If this person has worked for us within a certain period of time, we capture their work. This expense has already incurred, even though we haven't paid the check. The employee has been working for our corporation for 10 days, for 2 weeks. Okay, so this $900 is not yet a cash payment, but is considered a liability that corporation owed to employees. Right, so this is the idea of one type of adjusting entry. We adjust the payable, we adjust salary expense before the monthly statement is being given out. So the right-hand side salary payable, without this entry, then the total liabilities would also be understated. Okay, so this is an example of adjusting entries. Before a monthly statement is given out, we need to bring up some of the accounts to its current status, to its current value, based on matching principle and revenue recognition principle. All right, again, adjusting entries, what we're trying to do here, at the end of the period, we want to begin the trial. It starts from the trial balance where we left off in Chapter 2, and we add in some of the adjustments to make that trial balance, which usually we call unadjusted trial balance, into a adjusted trial balance form. Okay, so trial balance already captures the majority of the transactions. The ones that happens on a daily basis, all of them is captured here under unadjusted trial balance. What we're trying to do here, there's just a few of the transactions that ties to some of the transactions that happened earlier. For example, like the people that we hired earlier, we may need to adjust some of their salary payments here. Or let's say that we had prepaid rent expense before, we need to adjust the part that already expired, the part that we've used up. Or some of the insurance premium that we paid before, we need to adjust the part that has expired, that's no longer in force. Okay, so there's just some of the adjusting entries that need to be made, but the majority has been done already under trial balance. Okay, so the purpose here again is because earlier that trial balance is incomplete with some of the adjustments under revenue and expenses that haven't been done. We want to bring those accounts up to date to its current status. Another example will be supplies. If we purchase, let's say, $2,000 of supplies January 1st, and within this month we actually used up a portion of it. Let's say those supplies are stationary. Usually within the corporation you would not be recording each and every value of each piece of paper or each value of the pens that you use, that the different offices uses on a daily basis, because these are minor transactions. Okay, so for these minor transactions, the dollar amount are very little. We don't capture this on a daily basis. We wait until before the monthly statement needs to be issued, then altogether we adjust what are the leftover supplies that we still have on hand and what are the differences. So at the beginning of the month, we purchase $1,000 worth of supplies. When it comes to the end of the month, there's only about $600 value left of supplies. And we know that within the month, we have $400 of supplies that turns into supplies expense. Okay, so this will be another example, how we adjust earlier the amount that we prepaid for supplies and adjust the part that we actually used up. All right, so accrual accounting at the end disguises to do some adjustments at the end of the period because we want to have correct balances, up-to-date balances. So that's the whole purpose of this entire chapter. I'm going to bring up some of the accounts, so making sure that what is reported under financial statements is what actually it's the data that represents all the transactions that happened this month. Okay, now adjusting entries, it either affect a type of revenue or it would affect a type of expense. And then remember, each and every transaction has two accounts affected. So then at the same time, it will affect a type of asset or a type of liability. Okay, what we're trying to do, again, to bring up the accounts to its current status and to make sure that net income, assets, liabilities, the balances are correct. Right, so it either affects a type of revenue or a type of expense, and at the same time, the type of asset and liability. So if I go back to that supplies example earlier, if I want to adjust the value of the supplies at the end of the month, what would be the two accounts that will be affected? Exactly. So that will be a type of asset account being affected, reduced. Supplies will be reduced from current asset account. And that part, remember that example, if we had 1,000 before that we purchased up front, at the end of the month, if we only have 600 left, that $400 will be reducing supplies and turn that into supplies expense, into a type of expense account. So that entry will be affecting debit side expense, credit side asset. Okay, now for the earlier example that I gave you, the salary example, remember if we hired a person and when it reaches the end of the month, it's not the pay date yet, but the person has been working, the employee has been working for the corporation for some time. So then at the same time, we have salary expense debited. But if we haven't actually paid the check, then that will be salary payable, a type of liability. Okay, so each and every transaction either affects a type of revenue or a type of expense, and at the same time, another type of asset and liability. Okay, so this is what an unadjusted trial balance looks like from Chapter 2. We will be adding to this unadjusted trial balance some of the adjustments, adding a few more columns to the right-hand side after you understand what is adjusting entries. Okay, so this information that we covered in Chapter 2 is still there. We're just adding some of the adjustments accounts later on, expanding the columns to the right side. Okay, at the end we'll have an adjusted trial balance. Now some of the rules for adjusting entries, the upper title is Rules for Adjusting Entries. It never involves cash account. Okay, this is an adjustment that ties to one of the transactions that happened earlier. Like the supplies example, if you purchase supplies in the beginning of the year, what we're trying to do is recognize the part of supplies that disappeared, that we used up. So the payment is already made before. Adjusting entries is just to try to figure out the part that we used up or the part of, for example, the prepaid rent, prepaid insurance that has expired. So all of these adjusting entries, the 5 categories, will never involve cash accounts. So the cash is either earlier been paid or the cash will come in later, afterwards. If it's an accounts receivable, that will be later, that will be cash received for later on. If it's accounts payable, that will be cash payment later on. So here we're just trying to adjust some of the accounts. Just remember that the tip here is that if you're trying to figure out which side to put cash, then that's not adjusting entry. So adjusting entries will never involve cash account. Now other tips when you go over to this week's homework, if you see the term accrued, that term means accumulated, and usually that will fall under one of the adjusting entries. Okay, accrued means accumulated. Incurred could be accrued revenue, could be accrued expenses. So that salary example will be an accrued expenses. The employee worked for you for 2 weeks, you haven't paid a check, you accrued, you accumulated expenses that relates to salary payment. Okay, there are 5 categories of adjusting entries. We talked about a few examples under prepaid expenses, talked about salary payments under accrued expenses. So there are some of the other ones: depreciation, accrued revenues, and unearned revenues. Okay, 5 main categories. I'll be giving you some of the examples for each and every category. So generally speaking, these 5 categories, they're either a type of prepayment, like prepaid expenses. It could be prepaying rent, prepaying insurance, or they're a type of accruals, accumulated revenue or accumulated expenses. Okay, so it's either prepayment, like number 1. Number 2 is also considered prepayment if you purchase asset up front. Later on, we want to depreciate the asset, recognize the part of the asset that is no longer useful. That's what depreciation means. Recognize the part of the asset, the value that has already grown old, that is no longer useful. Okay, or it would be number 3 and 4. It's the type of accrual. You accumulated expenses, accumulated revenues that is still, again, not yet related to cash. So it's future cash receipt or future cash payment. Unearned revenues is a very special account. This term here is not a type of revenue. It's a type of liability. Okay, so unearned revenue refers to the cash collection that you, for example, this corporation collected cash upfront for a type of service that they will be providing in the next 6 months. So under the circumstances, they collected cash from customer, from clients upfront. They owe the client and customer a certain type of service or the goods. So as long as they have not yet fulfilled the sales agreement or the service agreement, this will be a type of liability, the revenue that they have not yet earned. Okay, let's take a look at the first one, prepaid expenses. So this is reviewing Chapter 2 a little. Chapter 2, I mentioned this category. It's under the asset account, remember? Prepaid expenses is not a type of expense. It's a type of asset. We prepay the rent for 6 months, and we have the right to use the location for 6 months. So this payment is made in advance. This is considered a benefit that business can actually use for the next 6 months, next half a year. So it's not a type of expense. It's an advance payment of expenses. It's considered assets. Okay, now the reason why this falls under one of the categories of adjusting entry is because, for example, earlier prepaid, perhaps a portion of that has readily expired. So if we prepaid rent for 6 months, on January 1st, when it reaches January 31st, then a month of rent has already been used up, has expired. It's no longer a part of asset. It turns into rent expense. Okay, the idea of supplies is also falls under this category. So you purchased $1,000 worth of supplies. After a month, you used up, let's say, half amount of it. You have only $500 of supplies left, and you will have supplies here, and that turns into supplies expense. Okay, what we're trying to do here is that earlier, in the middle of the transactions, you might have some of the purchases that you made earlier. You purchased supplies, or you have prepaid rent. When it reaches the end of the month, when you're doing financial statements, some of those entries needs to be tweaked a little, need to be adjusted a little to match with the current status. Okay, so we're just trying to adjust some of the transactions that happened before, just make it match with the current status of the business. So if you have prepaid 3 months of rent, and now you used up a month already, you only have 2 months in force, then you want to turn that month into rent expense. If you purchase supplies that should have lasted for an entire year, after a month you go back to reevaluate the value of supplies that you still have on hand. The portion that you used up turns into supplies expense. Okay, so let's take a look at an example here. Now, what does this transaction tell us? So May 1st, we have cash inflow or cash outflow. We have cash outflow for the purpose of getting benefits of using a certain location for how long? For 3 months, right? So you see the bracket there, 1,000 times 3, and at the end it says paid rent in advance. So let's assume that this $1,000, this $3,000 is worth of using a certain location for 3 months. So meaning each and every month the rent expense is $1,000. So this is May 1st when we actually make the payment in advance, prepaid rent. So prepaid rent is an asset category, that's why we debit it. Cash we're using up, so we credit cash. Now after a month, when it reaches May 31st, we want to adjust this account because the 3 months of rent that we paid in advance we only have 2 months left. Right? There's only 2 months of this payment that is still in force. So if the company is doing monthly statement when it reaches May 31st, this will be the adjusting transactions that they will be making. Okay, so that rent, prepaid rent, will be credited because this type of asset, a portion has been used up and it turns into rent expense. So meaning when you look at financial statements, when you look at prepaid rent account, you will only see $2,000 there at the end of May because that only represents the next 2 months of rent benefit that the company has. It represents June, represents July. Then under income statement, you will see rent expense $1,000, which represents the money, the rent benefit that they have used up within this month. Okay, so if the company do not record this transaction, if they haven't recorded this transaction, then it would seem like they still have prepaid rent that will last for the next 3 months, for June, July, and August. And if that's not the case, then this transaction has to be made. Okay, so the previous entry, May 1st, would already be captured somewhere here in the middle of the month. Okay, at the end, what we want to do is this entry, this adjusting entry here. Just turn a portion of that it has readily expired, that's no longer in force, turn that into expense. So here we're reducing asset, increasing expense. Okay, so this example here can also work for insurance. The company may be prepaying a certain type of insurance for 3 months. So May 1st, that transaction again will be captured somewhere here in the journal and ledger. When it reaches the end of the month, when we're trying to get to monthly financial statements, before that, we want to do an adjusting entry here, turn prepaid insurance into insurance expense for $1,000. Okay, this can also work for supplies. You may be purchasing supplies, $3,000, using up cash. At the end of the month, we go back to reevaluate what's the supplies value that we currently have on hand, turn the portion that disappeared into supplies expense, reduce supplies. Okay, so this same entry, the concept can be used for different types of prepayments. Now in the middle, you'll see a prepaid rentee account there. After we do this transaction, what would happen to that T account? Would it still look like that? What would happen? What would it look like then? First of all, prepaid rents, again, is an asset account. Asset rule would be debit increase, credit decrease, right? So earlier when we prepaid this rent benefit, we have an increase $3,000 here. After this journal transaction, we actually used up a portion of that, turned into expense. So this asset account will be reduced by $1,000. Then what? Their normal balance will become $2,000 and we'll be posting it under the debit side, the side where there's a plus sign. Okay, so this you would see after the adjusting entries, you see this T account be updated by into this 2,000 balance instead of 3,000. Okay, this here represents 3 months of rent. After a month, we don't have $3,000 in force anymore. We only have $2,000 left for June and July. Okay, so under balance sheet at the end, when you see under the balance sheet, the left-hand side assets, you see $2,000 listed here instead of $3,000. Okay, so this is an adjusting entry for prepayments, turning assets into expense, the part that expires. Okay, let's move on to depreciation. So this is a second type of adjustments. Depreciation represents the decline in the asset's value as the assets is being used in the business. And typically here we're referring to long-term assets. Okay, can you give me some of the examples of long-term assets? Meaning the assets that can be used for more than a year? Just randomly, some of the examples. Building. What else? You have equipment, usually machinery, furniture, fixtures. All of these are typically the assets that can be used for longer than a year. Okay, so their usefulness is not like supplies that it's easily been used up within a year. It's usually there in the business. They're usually larger in size as well, longer in lifetime. So we'll be evaluating their value based on depreciating them along the years. So meaning that this piece of furniture here, I may estimate in the beginning, once I purchase it in, the corporation may estimate it to have, let's say, 10 years of lifetime. So if I purchase this asset with a value of, let's say, $1,000, and if I estimate this furniture has 10 years of lifetime, then every single year I will be reducing the asset by $100. So this is the idea of depreciation. If the lifetime of the asset is 10 years, then as I use this asset in the corporation, I'll be reducing the value by a certain amount every single year. This is what we call depreciation. We are measuring how we have been using the asset and assuming that the asset's value has gone down, has declined along the years. Okay, so this is only used for long-term asset. For the assets that is usually there in the corporation for longer than a year. Okay, we're trying to measure the value, the usefulness of the asset. It has gradually degraded along the years as we use it in the corporation. So the beginning value is the value when we purchase it in, assuming it's $1,000. Then at the end of this lifetime, within the process when we use the asset, we'll be reducing it based on a certain value. This is called depreciating the asset. Reducing the asset's value. Okay, so one of the accounts that we'll be using for assets, for long-term assets, will be a depreciation account. This depreciation itself is an expense account. Okay, so expense account, whenever we record that, assuming that $100, it will be captured under the debit side. Okay, so we're trying to allocate the planned assets value cost to expense account. The original purchase cost is a certain amount, and we'll turn that part into depreciation expense. Also at the same time recorded under another contra asset account called accumulated depreciation. So these two accounts always goes hand in hand, goes together. Whenever we're trying to record the value decline for a certain long-term asset, we'll be debiting depreciation, and the credit side is always accumulated depreciation. So this is a special case for assets. So earlier, remember in the supplies case, we just directly reduced supplies and turned that into supplies expense. Okay, so here for long-term assets, because the value usually is it's a lot costly than other supplies, other short-term assets. So under balance sheet, we usually have, remember, there's furniture, there's land, building. You have different T accounts. In those accounts on the debit side, you will usually see the original purchase cost. It's always there. Whenever we record reducing the value of those assets, we have a separate contra account called accumulated depreciation to record the part that we estimate has gone down, the decline of the values for long-term assets. So which means that we normally don't touch the original long-term asset account until we're actually selling this asset, or until this asset is no longer useful anymore. We're taking it out from balance sheet completely. Otherwise, you usually see this account there for good, and this amount we usually don't go back to change it. It represents the original purchase price. And whenever we depreciate the asset, we use these two. It would be debiting depreciation expense. As I mentioned earlier, this is an expense account. Holds the expense of the long-term assets. On the right-hand side, we have a contra asset account called accumulated depreciation. Okay, so under the original asset account, it represents the original historical cost of the asset, which is the purchase price that we made earlier. But then if you see under balance sheet accumulated depreciation, then that means, for example, here, the company has used the asset for a year. So if you have used the asset for 2 years, you see $200 here. And you'll see another $100 here. Okay, so the amount you see under accumulated depreciation basically will represent, you can tell how long the corporation has had this asset based on the amount you see under accumulated depreciation. The longer the asset has been staying in the business, the more accumulated depreciation you will see here. Okay, so this accumulated depreciation, the normal balance is the right side, is the opposite of regular asset account, just because itself it represents furniture or building or machinery's degraded value. Okay, let's take a look at an example here. Assuming that there's a piece of furniture that costs $18,000. And let's say the useful lifetime, we estimate that it can be used for the business, within the business for 5 years. So that's about 60 months. Okay, so if we want to measure a month of depreciation in this monthly statement, that would be $300. Okay, use $18,000 divided by 60. Okay, that would be $300, and we want to measure that the business has been using this furniture for this month. We'll be debiting depreciation expense, crediting accumulated depreciation for furniture. Okay, depreciation expense is debited. Remember, whenever there's expense that accumulates, we debit this account. Accumulated depreciation is a contra asset account. Contra means the opposite. Okay, contra asset means the opposite of a regular asset account, but it still falls under asset category because it's trying to capture the asset's value that has been reduced for furniture, for building, for machinery, for long-term assets. Okay, so the opposite of regular asset account, its normal balance is the credit side, but it's still part of the asset family. So whenever you see an accumulated depreciation account there, that definitely means that the business has some sort of long-term assets in the upper part of the financial statements. So those two, if you match together, you can figure out the book value of the asset. Okay, so meaning that if you have a furniture that's worth $18,000, you see $18,000 listed under furniture. If you see $300 listed under accumulated depreciation, then you know right now you can estimate the value of the current asset will be $18,000 minus $300. So the $300 represents using the asset for a month. Okay, again, so for this example, we have furniture purchased, say May 1st, $18,000, and it will be used for 5 years. 5 years, if you're doing a monthly statement, then every single month we'll be recording $300 of value decline for this long-term asset furniture. So this is an entry that we're trying to capture within this time period, just for a month, how we have been using this furniture asset. So in accounting, we always try to measure up the part of the expenses that relates to revenue. So for long-term asset, this is how we measure how we have been using long-term assets. We divide divided by the lifetime of the asset, turn that into expense. Okay, so furniture value here, under furniture's T account, you will always see $18,000 here. This represents the original purchase price. And then you will have an opposite and accumulated depreciation account, which is a contra asset account. You will see this $300 listed here. Opposite side, remember accumulated depreciation reduces assets value. And then under the expense side, you will have depreciation expense, also $300. So these two refers to this transaction here. Debit depreciation expense, credit accumulated depreciation, altogether represents that this $18,000 worth of furniture is no longer has the value of $18,000. It reduced $300. So when it comes to June, we will do this transaction exactly the same all over again. We would do another $300. Next month, another $300. This is a recurring entry that happens. But we just spread the cost along the years to represent how the assets have been growing old in the corporation. Okay, so we do this for each and every type of long-term asset except land. Okay, land is an exception that we don't depreciate the value, but all the other accounts we do depreciations for it. Okay, land we usually assume that it has an indefinite lifetime. So land is one of the exception of long-term assets that we do not depreciate. All the others, building, furniture, fixtures, machinery, equipment, all the others that you can think of that last in the business for longer than a year, we have to depreciate it. So furniture may be harder to link to why it's growing old, but if you think about machinery, think about equipment, the longer that you use, usually in the corporation, the more repairment or maintenance expense you will have to use to support the machinery to work as well as before when you just purchased it. So that is pretty much the why we're doing this depreciation. So the longer in the corporation this asset is being used, usually the value will gradually degrade. Okay, this is what we're trying to do in depreciation account. So if we take a look at T accounts after recording this, under the asset category, the upper table there, see normal asset, furniture account $18,000. You will always see the original purchase cost of that asset. Right-hand side, we have a separate account that holds how we measure the asset's value. When we decline the value, we record it under accumulated depreciation. So whenever you see accumulated depreciation on the right side, that means we're trying to measure the value of the assets, the part that has grown old. Okay, that account goes together with depreciation. We also see depreciation expense $300. Okay, so if this question gives you 3 T accounts and asks you what is the current book value for the asset. So think about its current value of the asset. That would be using the original $18,000 minus the value that you see under accumulated depreciation, $300. Okay, so the current value of the asset would be, after using it for a month, you can measure it as $17,700. So meaning when it reaches the following month, after June, then this will be $17,400. After July, $17,100. Okay, the following month, $16,800. So we'll continuously to reduce $300. Okay, any questions so far? Now today is a lot of new stuff here that we haven't covered in Chapter 2. Okay, we started from some of the theoretical concepts. Remember matching principle, and we want to match all the expenses, the cost against all the revenues. Okay, here in the adjusting entries, when it reaches the time when we want to do financial statements, we want to make sure that each and every account actually represents the current status. So all of these adjusting entries, the 5 categories so far, we talked about 2 of them. These adjusting entries are trying to help the business update the accounts. And most of these transactions that happen ties to one of the transactions that happened before. So like salary, you have earlier given biweekly salary, but when it reaches the end of the month, if it's not the same date of the pay date, it's not the cutoff point yet, you want to record salary payable. So for prepayments, when we use up a month, we want to record the parts that actually turn into rent expense or supplies expense. For long-term assets, as we use it in the corporation to support business operations, we want to measure the amount of value that has been degraded, has been declined, using depreciation accounts, depreciation expense, and accumulated depreciation. Okay, make sure you get this concept here. Accumulated depreciation is very important to know, and also remember that it has the opposite direction of asset. This is kind of like the idea of expenses and dividends. The account itself degrades equity value. Accumulated depreciation basically represents part of the value that's no longer there for this asset. It reduces regular assets value. Oh, the book value, basically, you get this amount from looking at these two accounts. Basically, it's already there, $17,700.
Is there like a normal balance in the accounts? Like how
The normal balance later, and so under financial statements in Chapter 4, you will see that there's furniture listed first, and then there's accumulated depreciation of furniture listed behind it, right next to it. So then you will have a summarized balance, $17,700 next to it. So it's already there when you look at these.